You're on.
Welcome, everyone. This is the Gatewood Wealth Solutions weekly market commentary broadcast. I'm John Gatewood, and with me today is Aaron Tuttle. Aaron is our Chief Investment Officer. Welcome, Aaron.
Almost didn't make it, John. You changed the location on me.
What do you think? You like these new digs?
I think it's nice. I think a lot of our clients haven't been able to see the lobby. It's great that we can show them.
It is, because we're going to try a new format here today to make this more of a casual conversation as we talk more specifically about the market. But we just had the Republican National Convention the last 2 nights. We talked about the Democratic National Convention. We're going to talk a little bit more about that today. But why don't we start with going over our timeline for where we are with COVID?
Sure. So as our viewers know, we've been looking at the timeline and monitoring that. And I would say it's the first week that we've been a little bit concerned about what we're doing. We're still tracking the climbing out of that deep hole. We're still tracking the industrial activity, but we're starting to see some signs, which we'll talk about later in our conversation, that gives us some pause and what we're doing in portfolios to help offset that.
Yeah, and I know that the numbers have been somewhat stable, although the last couple of days in terms of the number of cases we've had a little bit more of a spike. Not a big spike, but we'll have to see if that's a trend or not.
No, I think the downward trend in new cases is going to continue to decline, at least for the near to medium term. We may be able to see, remember this is a coronavirus, so they do come back in late winter, early spring. But I think we've seen the worst of it so far in 2020. Knock on wood saying that, because we don't want to see more. The other thing is we've seen those new daily deaths really decline. And I think there's actually a change because we're starting to see deaths drop. We're seeing a little bit of a change in the conversation when it comes to the coronavirus and those deaths.
Yeah, well, let's talk about the impact that this is having on the major cities like New York City.
Well, the first one is the World Health Organization. So that we were talking about, the World Health Organization is starting to see some unintended consequences from the shutdown, which there's a big spike. There's been a tripling of the amount of anxiety in the U.S. and a quadrupling of the amount of depression. So there's some questioning on how people are dealing with the shutdown. But to your point on New York, it's not just the medical conditions that are important and that people are starting to question. The culture, the downtown experience, the greatness in our cities have really been struggling. And there's a realtor group, actually many of the real estate property managers have been discussing with the large corporations in New York about a get back to work campaign. And they're certainly self-interested, but bias doesn't make you wrong. And they are pointing out that we have issues. There's things that made New York great, that the shutdown and the work from home policies are really impacting one of our great cities. And it's not the medical thing, it's the quality of life. Why do people go to cities that are so expensive to live in and that you can't have a lot of space?
Well, there's so much culture there.
Oh yeah, the culture. The ability to have those restaurants. I mean, there just isn't a better place in the world to go to eat than New York. Those restaurants are fantastic. Most of those have been shut down or reduced to just some type of out in the street table service or carry out. That's not the experience or that quality of life that many long for. What about the arts? Going to the theater. I mean, Broadway. Can you go to Broadway? No, you can't go to that. So I think there's a lot of questioning right now as we see the deaths start to decline. We're starting to look back at some of that fear about the virus and saying there are things that we miss. And there were things that have happened on a cost-benefit analysis that I think are starting to pop up now that some of the emotional component and fear of death from coronavirus is starting to decrease. That a lot of and it's not those that have been critical of it, right? It's the World Health Organization, it's the CDC, and yes, the self-interested real estate organizations with New York. But I still think they have a really good point.
Well, we were talking about the fact that Harvard now has this initiative where they have an economics professor, an epidemiologist, psychologist, sociologist, psychiatrist, and what they're trying to do is to see could there have been a better solution, because all these different outcomes that are coming about that were really unintended. Of course, people wanted to save lives, but it's created other issues. And how do you, as you say, make decisions where you're evaluating the cost benefit from other aspects other than just stopping the virus itself?
Right. I think Senator Rand Paul asked Dr. Fauci this early through the coronavirus pandemic was, well, did you take into consideration these other parts? And he admittedly said no. Why? Because he has a good goal, which is to reduce the amount of deaths through coronavirus. But you really need a multidisciplinary approach to understand all the different things. The world is just too complex to say this is our one goal. I think we were talking before where, well, if your goal is to save lives and any one life is worth it, well, we don't apply that to, let's say, driving. So how do we make these assessments going forward? And I think now that we're getting out of the worst part of this, it would be good to reflect back on what did we do right, how could we improve on the situation, how could we bring a little bit more certainty, and how do we create solutions that are not one size fits all, because everyone's risk category is different.
One of the things that we were talking about earlier too is the fact that, you know, what we're doing is we're looking at this in terms of how will these decisions impact the market,
right?
Because we're trying to manage portfolios and clients' financial plans. But you had mentioned that since there's no end date to
right.
the lockdown, maybe you can comment on how that impacts decision making and what we're looking at.
Right, so, and we'll get to a slide here on unemployment, but if you guys remember that at one point we had 15 days to flatten the curve, and then that got moved out and we would start to assess, well, how many, do we have a decline over a 14-day average before we can go to phase 1, phase 2, phase 3? And we made it into phase 2, but then we had to roll back phase 3. And then we came out with mandatory masks. Well, the difference where we are now is prior to that, there was something to look at and assess whether some of this was coming off. Now there is no date for any of the mandates to be removed. There is no date for reducing the restrictions. So how do business owners take that uncertainty into consideration? And we've seen some pullback and some slowing in the economy, which is what we were talking about the first time we've had a pause. And we think a lot of that is people not having a way to assess where is the endpoint, what can I be looking at and monitoring before I know that it's okay to move forward and bring some people back because there's going to be some demand.
Well, this
right
is
now
we
it's
really need we need some leadership in this, which leads me to the national conventions, right? We have the Republican National Convention that's been going on the last 2 days. We had the Democratic National Convention last week. And you had talked about last week how these conventions tend to give an uptick in the polling.
Right.
What do we see so far?
Well, it's still too early to see an uptick in either the Democratic National Convention or the Republican National Convention. We will see polls for the DNC first because they were the first ones to do. But why do people pay attention to this? Well, here we can see that Kerry and then McGovern both had negative or no bump whatsoever. We all know that they did not go on to win the election, right? But a simple rule like this, I think, is just that, a simple rule. There's always an outlier. We can see that Mondale was up, I got a 9-point bump out of his convention, and Reagan had a +4. Well, we know who went on to win. So I wouldn't say that there's an absolute component, but to your point, people are absolutely watching this. And there's actually some kind of almost a self-fulfilling prophecy component or a gamesmanship that people are trying to do or use. So whenever we look at different polls, we really want to pay a lot of attention to what's being said, because if you can get some momentum coming out of this and people assume that, wow, there was a nice big bump, that means there's a lot of approval, a lot of people will just go along with that. We've seen that before where people will poll the audience right after a debate for the winner, and then the next morning after the media has had their opportunity to make comments about who won the debate or not, we'll have different things. So it'll be a toss-up on the initial poll, and then it'll be heavily skewed to whoever the media had said had won. So this type of gamesmanship, and both sides do it, is something that we expect to see coming out of this, and we already started to see. Here's an example where half of America saw a little of the Democratic convention, right? And out of all Americans, 72%, let's see if I can get that to work, 72% of it approved. Well, that sounds like a pretty positive announcement, but then if you look at the details here, you can see that it was among those who watched any of the 2020 Democratic National Convention.
Yeah, so anybody who's seen that thinks that it's a 72% approval rating
Right.
of all Americans,
right.
where in fact it's just 72% of viewership.
Right, which is going to be predominantly Democrat. Of course they approved of it. That's not surprising. So you got to really be careful with the headlines that are going to come out. Another one for headlines that we saw, and we're going to do this with the Republicans because they're going to be
happens on both sides.
Right, it happens on both sides. But this one I thought was really interesting. So Biden draws highest TV ratings of Democratic convention. Well, that sounds like the blowout. But then you have comma, but down from 2016. Well, how do you reconcile those two? Well, if
You're the best.
Let's
just not count 2016.
If we read in further into the article, it's while drawing a smaller audience than Hillary Clinton's speech in 2016, and it was actually down 21%. So what is this telling us? That Biden had the highest ratings of all the speakers? Well, he's the keynote speaker. Of course he had the highest ratings of the DNC convention. And you know, is this concerning with a 21% drop? Remember, there's nobody in the audience. So all of those people should at least be added to the rolls. Why are we seeing this drop? Now, we haven't seen great numbers yet on the Republican National Convention, but they seem to be down as well. So is it that people are not paying attention? That could be one thing. We've definitely focused more on the coronavirus that's kind of taken away the headlines. Maybe people aren't aware or as aware that it's going on. Or another idea is with all the alternatives being able to watch online, maybe those aren't being captured in the
right.
numbers, so they're still down. And just to try to be fair in this one, hopefully we'll be able to beat up on the Republicans next week. But the Rasmussen poll, I'm not calling this out in the slide, but the very top one has a 51% approval for President Trump. Now we looked at this.
He's never been above 40%.
Right, we were at 39% approval rating just a couple of calls ago, so that's 2 weeks ago, and we were commenting on he'd never been at 50%. Now, if he didn't have it in the honeymoon period, and we're post the coronavirus, in the middle of a recession, I think it's kind of a stretch here to say that he has a 51% approval rating. There's probably some bias there.
So the issue is, we know that polls can be skewed.
Sure.
But even if you look at the poll itself, when you're looking at an article, you're capturing the headline, and the headlines can slant what the actual information is in the poll. So how does one go about determining whether or not what they're reading or what they're seeing is accurate or even relevant?
Well, I would always remember that the person writing the headline is probably not the person that wrote the article. And the person writing the headline is about selling newspapers. So know that there's a component. So don't judge something by the headline without reading the article. And then when you get into these, one thing, there's slander and libel. It's really, you can become, there's a risk of outright lying. So that's usually not going to happen within the entirety of the article.
So there's always some truth.
Right, there's always
some really understanding what the truth actually is.
Right.
Things.
And then if you really want to get in there, and I did this with the Ipsos data, you go into the methodology. And a lot of times, and they may have good reasons, it's not nefarious always, and probably seldom is it nefarious, where they'll oversample. That example is they were oversampling Hispanics and blacks within that outline as well, so it would skew it a little bit more because they tend to be more Democratic. And one area that we like to look at is 538's website. That's the Moneyball. The name of the person is out of my brain right now.
Yeah. So for our listeners who are not familiar, Moneyball, it was a fellow that was an amazing statistician.
Yes.
Is an amazing statistician, and he's applied this to this website.
Right, so he goes out and he's trying to understand what are the biases that they see over time with the different polling agencies. They actually give a stewardship rate of how good that polling agency is. Most of them tend to be in C's, and that helps you understand whether it's intentional or not, what bias. So a great example, I think, historically is right here in St. Louis. President Truman was holding up a newspaper that says Dewey defeats Truman after he had won. And why did that happen? Well, they didn't think about their methodology. Back then what they would do, it was Gallup, they would go knock on doors and ask, hey, are you going to vote Republican or are you going to vote Democrat? Well, to make it quick, they would just go to the corner of the street and then they would knock on the corner, on the houses on each corner. Well, the way that things were set up then was the house on the corner tended to be the biggest house. The person that owned the biggest house tended to be a Republican, so you were actually oversampling Republicans in the poll. They didn't do it intentionally. So the 538 goes back and says whether intentional or not, what is their methodology doing? What's the error? And what
Just goes to show that methodology does matter.
And I think it's also, an old adage is figures lie and liars figure. So always take these things with a grain of salt, whether it's the figures are lying or you got a person.
Well, the reason that we're tracking the polls, of course, is because we're trying to determine who's going to likely become elected. Of course, who knows? So let's talk about how is the economy actually doing right now?
So we are definitely seeing a slowdown in that growth. So we've been climbing out of that deep recession and we've been on track, but we've noticed, and you can see it here, we've been pretty flat over the last few weeks. And this, interestingly, has one of the detractors for the week is housing starts. And we actually just saw yesterday there was a stupendous rise. We're at near 13-year all-time highs whenever it comes to housing measured in specific ways.
So should we be thinking about 2008 then in that case?
I don't think yet. I think a lot of it is a legitimate demand. So people want bigger homes after this, being that there is this uncertainty and risk of having to stay quarantined in your home. There is this movement to suburbia. There's also, when you look at financing options, yes, debt is cheaper than it was before on borrowing from houses, but whenever we look at it relative to treasuries, it's actually even more discounted. Other financing options are actually, there's less spread between those two, so that really favors home prices at the moment. Another thing that didn't detract though, and one we think has a lot of concern for us, is seeing the unemployment numbers, that initial jobless claims. We were talking about, it finally got below 1 million last week. It's now popped back over 1 million. And it's pretty close, so psychologically it's not it's meaningful being 1 million, but really there isn't much difference. And we don't want to make too much out of 1 week's change. But we think this has a lot to do with that uncertainty with the lockdowns and whether businesses are open. We're seeing businesses retract and not open. And the longer we go, we have said this from the beginning, if this is just a quick change in the economy, we had that 15 days and we're back to business, this is going to be the quickest recovery ever. Well, yeah. It did end up being the quickest recovery ever, but we're starting to see some concerning components because it's more dragging on longer than we anticipated.
It's more of a quick recovery in the market than it is in the economy. And
absolutely.
I think that's something that we need to make a distinction of.
Absolutely.
This is a lot of people who are unemployed. And we're hearing news like yesterday in the Wall Street Journal, they're talking about how American Airlines is laying off 19,000 employees from now on October 1st because all that federal aid is now ending. While there's still some money coming in because of the executive orders from President Trump, we still haven't really done anything else in terms of helping prop up business. And so how many more companies are going to be laying off? And we're seeing that here in St. Louis. Major companies that are laying off people and small companies that are not coming back.
Yeah, if we cannot get the economy open up again with some certainty and some rules, this will change from, well, it's like a natural disaster to a true business cycle downturn. So I think we're in an area that we really need to pay a lot of attention. We hope by next week that this was just noise and we see a drop, but clients can know that we are watching this and we're looking at it. We don't have Pollyannish glasses on when we're reviewing it. We're trying to pay attention to the data and let that move.
So what does that mean in terms of what we're doing to our portfolios?
Well, let's say the portfolios. One of the things that we've talked about though is that is the housing start, because one of the things that I think clients are going to hear, and they're going to say, well, let's raise cash, let's become defensive.
Right.
And really, when we look at it, well, our housing starts are near where they were at the beginning of the year, which was very strong. But look at lumber prices, that graph over to the right. So we may have as many houses being started, but we have more than a doubling of lumber prices. And I have a friend that's a developer, and he was just a couple of months ago paying $21,000 for a lumber pack to build a house, and he's now paying $32,000 for that lumber pack. So here's an example where the things that people are buying are going up significantly in price. So just going to cash because you think that there's going to be some volatility, there's some downside in the market, may not be the best option.
So how much of this is inflationary just because of the money supply or the amount of money put in versus
just change in demand?
Correct.
Well, it's both this. I believe, and we believe at Gatewood, that inflation is actually the expansion of the money supply, and sometimes you see the price of consumer goods go up because of that expansion. Now we expanded the money supply significantly, so it was inflationary. Capital prices went up in markets, but we didn't see that in consumer goods. There were a lot of reasons why that's the case. So I think all of it is inflationary. But some areas are still in a severe issue because how much travel are you going to do? So gas prices,
right,
airline tickets, hotel, all of that in the index is down. But look at steak and pork chops and chicken. Things that people are buying are going up substantially. So steak is up 28% from a year ago last month. So I would say that we do have these inflation risks. And then now it's not all bad news. Look at the big box retailers. So what they're buying, or what consumers are buying, tend to be in the Target or Walmart or the home prices. And Target was up 24.3% growth. I think it's a $1.7 billion flow for them. That's just eye-popping.
Wow.
It's just absolutely insane. And a lot of this is driven by online sales. Companies like Shipt is who goes and they'll do your grocery shopping, or the retail stores. There's a lot of gain here in these. And if we look at Walmart, another big box retailer, they're also seeing substantial increases. But one thing that I noticed was they are talking about supply chain disruptions. That they are selling a lot of things, but they're having a lot of issues trying to keep the shelves stocked. And they also attribute a lot of this to the stimulus checks that were going into people's pockets, driving these things. So, I think the big takeaway here is that we have, if these trends continue, where people that are employed and are homeowners are continuing to increase their spending on homes, buying big ticket items, that we continue to increase our grocery bills and other things. At some point things level out on all those things that we're not buying, and then the CPI moves up, so we start to see inflation. The other thing is supply chains, and a lot of companies that are not going back to work, they're not producing as much. So you have production of goods going down, and you have demand by people that are able to buy, and you will still have the Federal Reserve pumping in money to the market system. I think if these trends continue, we have a real risk of stagflation, where we have high unemployment and we have higher inflation.
That's what we had in the mid-70s.
It happens. There really isn't this trade-off where unemployment and inflation, if you can't have high unemployment and high inflation, or vice versa. No, that it's not a trade-off. And I think if these trades come in, so that's even more important. That's why you have to be very careful in portfolios when we're trying to manage these risks, that we don't become too defensive and go into an area that can lose value through inflation. We have to be more creative and more vigilant on how we allocate.
Tell us where we are in terms of the money supply now.
So as our viewers know, we like to look at the money supply. And this top graph shows that we had it was a rocket ship coming out of March. And that's one of the reasons that we were more aggressive. We had heavy beta in the portfolios, and that worked out quite well. At a 60% growth, we're now down to a 40% growth. And it's really about how much the money supply is growing relative to before. So the amount of money that we've created, we're probably not going to continue doing that ongoing, so we see this pullback. And down here on this bottom left, we can actually see the money supply stock. And you can see we had 3 negative weeks. Now, that lines up with that August 7th recess where we didn't get the stimulus package passed. And since then, we had executive orders. So we see a big spike. The takeaway here is the money supply is not growing as rapidly as it was. Markets are at near highs on valuation. This just isn't where we were in March.
So where would we see valuations going from here? Are we at a risk of having a correction?
I think we are.
It's kind of unusual because it's going down. It's a pretty big drop, but the amount that's out there is still huge. I mean,
Yeah.
that's the dichotomy here.
It is a dichotomy.
And how do we equate that or plan for that in terms of valuations in the market?
So what I don't want to say is that we're turning bearish, but what I was getting to is it's not March anymore. Valuations are certainly stretched. We're at all-time highs. We have the money supply coming down, and really we think that the Fed is going to be very erratic, but they're going to step in on a correction. So we really want to just make sure that we're not letting our emotions drive us, or that we're trying to second guess what the Fed is going to do, that we're really letting the money supply and these indicators drive what we're doing in the portfolio.
So can you talk about what the Fed is planning?
Well, they are meeting in Jackson Hole as we speak, and they have openly said they expect to continue to be adding money to the system. They may not do it as direct stimulus checks. They may be doing it through the market machinations where they're going in and buying securities. That's still money coming in. It's not going to show up in the big box retailers. It's not going to show up in the service, but there's still money getting into the system. So that inflation is there. What we think is going to happen is we're probably short term going to see some volatility, and it may be a little bit painful. Long term, it's inflation that's the risk, and they're telling us that. So we think we're going to have maybe 4 to 6 investment opportunities over the next 12 months as we try to have this massive amount of money go through the system. So this is not a time to become defensive because stagflation or inflation is such a risk, and we know that the Fed's going to step in if markets sell off. So if we get caught into a market that is selling off and we haven't become defensive before, you're just going to have to ride it out. And make changes and add on exposure as we go through. But we already have started to become defensive because it isn't March anymore. Right?
Well, let's talk about how we've been planning for clients.
So in our previous call, those that are approaching retirement and can afford, based on their goals and their analysis, we've recommended 36 months of cash in their cash fund, meaning that they would have access to enough cash to meet their expenses for the next 3 years, getting us past not only this election, but the next election. And that's plenty of time for the Federal Reserve to step in or Congress to step in with stimulus packages. We haven't had pain when we're dealing with this, so they're likely to respond quickly. I mean, the amount of money that has been created relative to 2008 is just off the charts compared to 2008. But if you're coming in, we would say buy on the dips. We'll add additional exposure to the market, add beta.
I think it was a really important point because as high as the market is right now, we are going to see drops in the market, but we do not want to take money off the sideline or become real conservative.
Beyond planning.
Beyond the planning. And that's the whole purpose of the cash, is that we're taking the chips off the table so that we're positioning portfolios so we're essentially insulating them from having to be liquidated or changed at the wrong time.
Right.
Because the market will trend higher. That is what happens over time. I remember, who was it that said, if you think the market's high now, wait till you look at it 30 years from now.
Absolutely. I think it was Nick Murray.
Nick Murray, that was what it was.
Now, this was our Jackson Hole. It was talking about the Fed. So just a couple points on that. They have said that they anticipate adding additional monetary stimulus to the economy, and they're removing that 2% target. This is probably one of the more important speeches that we'll hear. I expect the market to respond well out of this. So once again, we're not calling a top on the market. 36-month cash hub, and let's see. So one of the things that we want to talk about, we're not going to make it through this call, but is inflation and the inflation risk. We've been building up to this, and we're going to use Morgan Stanley's 4 Ds to help explain what we see, because it really does resemble what we see. And that's demographics. John, you're not spending as much money on new items. Your kids are now almost out of school. No, out of school.
They're out of school.
Out of school.
Yay!
Out of school. So that should actually cause some deflation, right? Because you're not adding to consumption on items. Except that there's entitlement spending tied to that. And that means the government is going to have to continue to borrow at a rate that's much higher. They're just not collecting enough. So there's a net effect that we think is inflationary.
Right, the Medicare, the Social Security benefits.
Right. Deglobalization. So the whole point that people in the market have made, and this move towards nationalism, doesn't matter what party, doesn't matter what country. The idea that supply chains want to be brought home and closer and smaller, we think that is going to impact, and that will not be deflationary. That is going to increase the cost. Trade is something. Global trade does reduce the price of goods. It allows people to specialize. You don't want to be in Maine trying to grow bananas whenever you could just buy them from the Caribbean island. And the Caribbean island doesn't want to say, well, our supply chain for maple syrup is so high up in Maine, we need to bring that up. No,
right.
The specialization and that does bring down prices. That isn't to say that there isn't an argument to be made for bringing supply chains closer to home. And we think this, just the uncertainty for this has made that
especially
a more powerful
right now.
argument, right? But there's trade-offs, and we think that causes prices to go up. Deficits certainly are going to cause inflation, and then dollar debasement, which is something kind of, those go hand in hand, really very specific to the U.S. So we're going to go over that in previous calls. Everyone's very familiar with our investment themes. We won't spend much time on that in this call. And then the market. John, it just keeps going up.
It's pretty amazing.
Yeah, climbing out that wall of worry.
Well, you know what's interesting, I was thinking about is the fact that I'm thinking, what's actually driving these indices to be so high? Because if the economy is not doing well, we know that the certain segments of the economy are doing very poorly.
Mm-hmm.
The ones that are doing well are doing exceptionally well, and those are the ones that are pushing the market up. I think that's important for people to understand that even though the market is going up, that doesn't mean that the economy is going up all over the place. It's really reflective of the certain areas that have done exceptionally well during this time.
Yeah, I think that's one of the things that we've tried to really make a distinction between the economy and market or the stock exchange, because they often coincide, but you get in times like this where they don't really map to each other. And it doesn't mean that the markets are wrong. It doesn't mean that the economy is great just because the market's great. They tend to be a leading indicator, but as you were saying, when the top 5 stocks make up more than 25% of the S&P 500, and they're growing, well, that's going to drive markets higher, and we've certainly seen that. And fundamentally, there's good reason that it's been driving it higher. One of the reasons that JP Morgan Insight has inflation low and our portfolios get affected by it is because we do have such a high allocation towards the U.S. domestic market. We think smalls and mid-cap companies actually benefit in this scenario. I hope to spend some time on that reasoning as we get to why we favor the U.S.
Our technicals have shown that,
yes,
that we did
absolutely.
very well last week, for sure.
We continue to monitor it. The dollar is definitely struggling in the market relative to other currencies because we've actually created far more dollars than, let's say, the European Central Bank has, euro. So we continue to monitor that, but as your point, technicals, our technology positions, our gold positions really had a great week last week. We were just in the right areas. We continue to be in pretty much everything besides commodities. We have a gold position.
So I know moving into the questions and answers, one of the things that the Wall Street Journal wrote about this week is the fact that there have been more ETFs that have closed this year than that have opened. You know, ETFs have become a popular way to invest. People would think that they're investing passively by buying a basket of the market. Maybe you can comment on this, and especially with regards to what's known as ETMs.
Yes.
It's a special form of an ETF that's leveraged.
Well, we can more than double the time that we've already spent in this presentation by going on how passionate I feel about this subject. So I'll try to keep it smaller.
Are you an activist?
I am an active trader, or at least I want to be logically consistent. John, one of the things that I find unusual for these passive investments is there's actually more exchange-traded funds that are available than there are individual stocks.
So it's almost like buying an individual stock.
It's actually more, right?
How do you know what to buy?
Right, all kinds of things. So ETFs, what is making them attractive is that they are a lower cost way to get access to the market, and there are certainly passive products, but a lot of them are factor investing or sector investing, and these are ways we use them. We're agnostic on the tool. We love the low cost and being able to get exposure to these sectors, but they certainly don't fit as an entire product, this passive type of product. But the exchange traded notes are another area that I think that, especially in that Robinhood world where you have all these day traders using it, there's a lot to understand whenever it comes to derivatives, and that's what these ETNs are. So it's a way to get double or triple exposure or try to match a future. And there's these concepts like gamma that you could put on that a lot of people struggle with, CFAs included, that you have to constantly be moving it because you don't get the exposure that you want. In addition, a lot of these products don't have a lot of trading, so the price isn't efficient. They can be moved up and down in rapid swings as a person tries to enter, and there just isn't much liquidity. The provider, usually Credit Suisse for some of these ETNs, isn't able to construct them fast enough, so you try to make a trade and all of a sudden you move the price of a share up to $10,000 and it was a couple of $100 before because of the amount that you're trying to go in, so they're not efficient. And then getting wonky here, but all of these products assume for probability that markets trade on a normal distribution, and the one thing I can promise you is they don't. And whenever you're building products as if they do, and then you start to have these tail movements, and then you have also the limited volume that they can handle, they continue to blow up. We had talked with a person at the Wealth and Asset Management program several years ago, back when we were sponsors of that great program. And the person was really just pleased with himself because he was buying the shorted VIX, or basically it was short volatility. So he was making a lot of gains in this. And when you looked at the modern portfolio theory statistics and the Sharpe ratio, it was a phenomenal trade. And it was a phenomenal trade until it wasn't.
Right.
And then it was gone.
Right when you're looking backwards.
Right. It was gone.
That way going forward.
We watched the VXV explode, and those shares become worthless.
Well, I think it's important for our audience to understand. So what an ETN is, it's like an exchange traded fund, but they're not buying the underlying securities.
No.
They're actually just borrowing money, and then they're using those securities as the leverage to measure what the performance is. So you get outsized returns when those underlying securities go up, but then you get outsized losses when they go down. We saw there was one ETN in the oil and gas. It went all the way up to $20 a share, and then it went down to 22 cents a share.
Well, remember whenever the futures went negative in oil earlier this week, or earlier this year, that ETF, USO, there was a lot of problems because the way that they gain access to oil is not buying the underlying oil, like you're saying. They're buying future contracts. And we had that really big mess in the oil, because remember, oil, we had so much oil we had no place to put it, So you had to take delivery because no one would buy the future from you, and nobody had a place to store the oil. So the price of those contracts, you were actually paid to take delivery. So that was the oddity on those components. So yeah, those, it's not to say they don't have a part to play in the portfolios, but they take a lot of skill that really even a lot of people in our industry don't actually.
Yeah, I think the point is that you can't assume just because something is an ETF that you're in a diversified strategy, because the ETFs really reflect oftentimes small segments or just slivers of parts of the market that may or may not be creating a truly diversified portfolio. But one of the other things I want to talk about is China, because we see a lot in the press about this administration now has been putting pressure on China. They've been, there have been issues with regards to security of TikTok. We've had bans on WeChat. But maybe I talk about what that means to the market going forward if these types of trends continue.
Well, I think they will continue. It's not if. I think and it doesn't matter Biden or Trump. We're in this political environment where we switch from globalization to more of a national component, and everyone's involved. China's trying to increase their domestic consumption. They're doing their Belt and Road initiatives. They're trying to have their South China Sea. They want to be the dominant player there. We have issues in India. The U.S. is trying to bring manufacturing back. They complain that, and they're probably right, that there has been intellectual property stolen. So it's no longer that Chimerica that we heard about a decade ago. There's decoupling in these supply chains, and then there's also a contention. The U.S. does not want to be challenged with their military might, right? They like being top, and China wants to progress their status in the world as well. So I don't think that this is going to die down or change. So a lot of this offshoring is going to come back to onshoring. I think that it is just the reality that we'll be operating in. China is reducing the amount of their treasury exposure. So there is certainly a decoupling that's going on between the U.S. and China, but there's also a decoupling going on between the U.S. and Europe. The dominant political belief right now is the way that you will become wealthier is bringing more stuff home, and that creates tension. I can't think of it's Professor Ong out of SLU, and he said, I think he was quoting someone, I'm trying to remember the quote, but basically, if goods don't cross borders, soldiers will. So that's one of the problems that we have, is as we have tension between supply chains and global trade, that will increase tension militarily.
Right, well that's the one miracle, so to speak, about global economics and free trade, is that it actually creates cooperation among countries and actually helps to avoid military conflicts.
Yes.
So we'll have to see how that plays out going forward, but I guess that'll make some difference in terms of how we would allocate the asset class of international.
Right, we talked about ADRs earlier this week, that one of the policies that the Trump administration has put on, or at least have warned about, is removing or at least limiting the access of Chinese companies to be able to trade here on stock exchanges through their own ADR, and that's going to be reduced. So we got to take that into consideration, even for a good company. What happens if some of these policies go in? So once again, we got to be very diligent.
It could be a great company and have a lot of value, but then when you put in these types of impositions, it could actually cause the value to the investor to be lower than what maybe the underlying intrinsic value of the company is.
Absolutely.
So, well, we've run out of time today. That was really a great discussion. I love the format. I hope our listeners have loved it. We certainly welcome feedback as we're trying to make this as attractive as
Question
possible.
for you though.
Yeah.
So let's say we have listeners out there, they either want to have their clients, they want to have a discussion about their cash hub, or they're individuals that are tuning in and they're not clients and they want to talk to somebody about their situation, how can they get a hold of them?
You know, so the best thing to do is to reach us at our website.
Mm-hmm.
We have some contact information there, or they can call anybody here on the team. We have lead advisors who will work and speak with people on a totally complimentary basis, find out what their needs are, and we're certainly happy to engage them in a conversation and help them sort through those important issues.
Yeah, absolutely.
So I do want to make a point that all the discussions that we had about any type of individual security is not an endorsement to buy or sell,
Right.
just commentary, and that past performance is not indicative of future results. We are certainly looking at the past, but we're always looking forward and trying to position our portfolios to manage the risk. So we welcome everybody to join in, have their friends join in. How would somebody come in and invite their friends if they wanted to listen to the broadcast either now or in the future?
Well, they could easily send the Zoom link that they are listening to now, but they could also go onto our YouTube site where these videos are posted. Please subscribe, because the more subscribers that we have, the better experience and the more features that we can put on the YouTube video. It helps us with being able to keep some of the videos in order so you could follow those items. So please subscribe, but next to the subscribe button, if you wanted to share that video and pass it on, maybe last week's video or even this week's video, it'll be posted soon. They can link those out and send it to their friends. And once again, the invite that they have for the Zoom link it can be forwarded on to them, and we just welcome all listeners and viewers.
Well, thank you again to everybody who listened in to today's broadcast, and we look forward to having you back again next week.